Okay, here we go. All right, welcome to training session number 7. Welcome to the second to last training. So we are closing in on the end of training. The time to start helping people is coming. I'm so excited for that day to come. So today we're going to do special circumstances. That's kind of the focus for today. We're going to do a tail end of some state stuff as well. And then next week we are going to do final clinic prep, talk about volunteer readiness check, start working on that. So your goal is to try to get caught up. Well, I'm going to get to that in a minute. All right. So we're going to do general updates. We're going to do a demo. I'm going to do the demo later. We're going to do special circumstances first. We're going to cover things where it's complicated, something's wrong, and we have to do something extra. We're going to do some state tax returns, except those aren't the right states, or not all of them. That's all right. And we'll wrap up again with more practice at the end when we kind of run out of material. So we'll take a break somewhere around 6:30-ish, and there we go. All right. So I wanted to give the group a quick update because there has been, with the changing of the administration in Washington, D.C., there has been a lot of kind of chaos going around within various government organizations. The IRS is no exception to that, and the VITA program is no exception to that as well. What I can basically say for now is I think that we are all fine. I think we just need to just focus on helping people do their taxes. If something significant changes, then I will obviously let everybody know. But for right now, I think we are all good. So we're gonna at least go forward under that current plan with that current information. Let me just hide that too. All right. Let's talk about volunteers then, a little bit more stuff. So everybody that is having so much trouble with the schedule OI days, TaxSlayer hears you and they are working on the bug. So it is not fixed yet, but they are at least acknowledging that there is a problem, which is the first step, right? And so basically they're saying, yes, if you do this and then you go forward to the e-file or the print and then you go back again, you can enter it again and it'll work, which is like very crappy extra work, but that will at least get the numbers in there. So the one thing that they're saying here that's really important for us is that it's both the TaxSlayer Pro Online, like the practice lab version that you're using, as well as the facilitated self-assistance version. So when you are helping clients here, you need to make sure that you're double checking for those days, because until this is fixed, even if they follow our instructions, the bug in the software may still accidentally delete those days. So please keep an eye out for that. As far as volunteering, so I'm not going to pester you anymore about signing up for tax clinics. I think we were down to like 2 people that hadn't signed up at all. So everybody has done a really good job of that. But what there is going to be is more nagging on Moodle. I'm sorry, but it's got to happen, because to be a volunteer at the tax clinic, you have to do more than just pass the IRS tests, right? You have to learn the software for the TaxSlayer, and then you have to learn state tax law as well. And you have to demonstrate that you know this material and you know how to do this before you can volunteer. So of the 55 or so volunteers who passed the IRS test, 12 of you, probably a lot of the faces that I see here are names on the screen, you guys are all caught up. Very, very nicely done. Great job. 6 people have made some progress. There's another 11 that just did Herald but haven't really done any more. And then 26 that have not done anything else in Moodle since they passed the IRS test. All right. I wish that passing the IRS test was enough, but it is not. And you can't go into the tax clinic without having more knowledge and practice and experience. There are only bad outcomes. Either you can't answer the questions, or even worse, you answer the questions incorrectly, right? And then our clients are the ones that are dealing with the negative fallout. So if I have to cut down the number of people we can help to 12 to 18 volunteer capacity, I would much rather do it now than in mid-March. So please, I will be nagging. Please work on your stuff. Please catch up, stay up. You've got to get through that volunteer readiness check. If you made it through the test, you can 100% make it through this, right? It's just a little bit more practice. All right, member update. We're open for the season once again, so everybody should go get a membership, file your own taxes for free, see what the clients see, all that kind of good stuff. We're looking okay on members so far. The first few weeks is always really slow. Usually sometime around the beginning of March, it starts to pick up again a lot more rapidly. So a slow, gradual increase is not a terrible thing now. But we're definitely doing what we can to start to try to get the word out on the clients, get to the clients about the clinics. So that is the focus for everybody else outside of this room. Here in the room, we just need to have you ready to help everybody. The good news is people are starting to sign up, so that's what we would expect. The first office hours is full, so that's great, and we'll keep going. Any questions on that before we move on? All right. So brief review from last week. So we're going to be supporting clients from state returns with 10 different states: Minnesota, Pennsylvania, North Carolina, California, not Carolina, California, Maryland, Wisconsin, Ohio, Kansas, New York, and Alabama, right? And we said, you don't have to learn all of those. We used to make everybody learn all of them, but that's way too many for everybody. So everybody's going to get Minnesota because we're going to have about half of our returns come from Minnesota. Then you got to pick 2 of Maryland, Pennsylvania, and Ohio, and then 1 of California, North Carolina, and those other ones. And then if anybody had any preferences for any other states, they gave me feedback on it, so that we could look to see where else people would like to learn how to do returns. This is what the questionnaire looked like. So about half of the folks responded to that, a little over half. I was actually very surprised. It was like a really pretty even distribution between the 3 big ones. California was a pretty big hitter right there. New York was second, so I can tell where everybody wants to go live once they graduate. It was evidently not Alabama or it was Massachusetts. So that's totally fine. If you didn't respond, I assigned you to ones that we didn't have a lot of people in. So this is not the final profile. The final profile is a little bit more even on those lower states. Totally good. All right. Just a couple of quick updates on the states that we already talked about. So for North Carolina, there was a disaster declaration for Hurricane Helene. If you were in North Carolina from September 25th through December 18th, you were affected by the hurricane to a greater or lesser extent. What this does is when they make this disaster declaration, the IRS gives the people that were in that area additional time to file and pay their tax returns. So they basically get 1 extra month. It's not going to really change anything that we do, but there is a number that you can put in on their federal return. There's also an entry in the North Carolina return as well. And then it prints out this disaster number at the top of the returns. You can see that Watauga Helene EMC 3617NC. That'll just let the IRS know that they need a little bit of extra time. You know, there's not really any major differences beyond that, but just in case something happens, why not give people a little extra time? All right, a reminder, we didn't really talk about it last time. So if this is your first time filing a Minnesota tax return, or if you have moved since the last time you filed a Minnesota return, you want to put a little X in the box that says new. That's basically the reminder to the state of Minnesota to say, hey, this person has their address that needs to get updated in their systems. And they've also added this county things. I am guessing that this is because of the renter's credit change. It's a type it in kind of thing. It's not a drop down to choose. So do that. You can just, in all honesty, I asked Minnesota Department of Revenue if they had like a resource for us, and they were like, no, just Google. So I never like going to Google for answers, but in this case, we will let Google Maps tell us what county you're in. All right. There's a special way to make California show treaty exempt income. So Pennsylvania, when we did, excuse me. when we did Harold, it was awesome because his W-2 had 6,000 in box 1 and it had 8,000 in box number 16, I think it was. So they did the treaty adjustment already for us, right? They reported the extra treaty or the non-treaty exempt income on his W-2. And Pennsylvania like took that 8,000 and they did all their stuff to it and it was great. California does not do that. Even if the W-2 shows that difference, they don't take that larger number from the state field. If you try to do that, it does not work out properly. So it is buried down in like 5 different layers. Basically, you go to California, income subject to tax, other taxable income, and then other income, and then other addition. And then you can enter treaty exempt wages and enter the amount. So it is like buried probably as far as you could possibly get down into tax layer to enter that information. But it is there. So if we ever do have somebody that has taxable wages that were treaty exempt, but they're taxable in California, that is how you make those numbers show up. If there is a scholarship, we'll cover that later today. It's not nearly as painful as that one is. All right, any questions on those before we move on to special circumstances? All right, so special circumstances. By now, you have probably realized, right, that TaxSlayer is not the most user-friendly software for non-resident aliens, right? There's lots of fiddly places where we have to enter the information. Think of the Schedule OI and the Schedule 8843, right? You have to enter it multiple times. It's not very easily found on the screen. We also have to enter it again multiple times for things like our 1042S. We enter the 1042S form and then we enter the income again. They don't like take the information from the 1042S and move it over. You have to do it twice. We also have situations where our clients' income documents do not exactly match what their situation is. They could have an undocumented income, such as a scholarship, or they could have treaty exempt income that is not reported as treaty exempt. So in those situations, we are the ones, or the clients are the ones that have to do that fixing. That's where our personalized guide comes in. It provides a lot of the support for it. But that's where you also get a lot of questions at the tax clinics as well. Oh, I know I have a treaty. I don't know how to claim it. Here we go. Let's talk about doing that. All right. So kind of mentioned this, right? So I will continue to ask you for the personalized guides. So please submit them with the scenarios that we do from now on. It is more helpful if you create the guide before you submit the return to me, because then you could have used it to actually prepare your return. This is what our clients are going to be using. So understanding how those look, how the information flows will help you be more easily able to help them, right? So as an example, I see that you entered your stock transactions on Schedule D, because that's what residents do. That's not the right place for non-resident alien students. Let's delete those, and then you can use your personalized guide to get those entered properly, right? Then that person can use their personalized guide. They will work on entering all of their stuff. You can go help another 2 or 3 people while they're typing all of their stuff in, and then you can come back to them when they're done to review, right? So that makes it much more efficient for your time, and you're not standing over somebody's shoulder watching them type numbers into the screen, which is not the most exciting way to spend 2 hours. All right, so let's talk about scenario 1, a scholarship or a fellowship that is not reported on a 1042-F. Theoretically, the IRS requires organizations report amounts paid to individuals and other organizations, right? So if you earn income of some sort, the IRS will say, oh, if it's more than this, then we want a document to know what that is. But it doesn't always apply for all types of income in all circumstances, right? It's intended to help simplify compliance and administration of the tax code. Also, right, make sure nobody's cheating too much on their taxes. The IRS does not require somebody that gives a person a fellowship to report that income on a document in most circumstances. However, for non-resident aliens, it is supposed to be reported on a 1042-S form. But not all schools know about that, and not all schools do that as well. All right, these are some of the other types of common documents that we'll see. They generally have minimum amounts as well. 1099 INT, I think, is a $10.
Make sure next time that we call.
Yep, somebody's not muted here. Oh, oop, that's all right. So anyway, 1099 miscellaneous, I think the minimum is $600 or 1099 NEC. If you get less than that, you're still supposed to report it, but they're not going to give you the document to show that. All right. Here's a bunch of information about what the U of M says. Basically, they warn you that in sometimes they may give you a document and sometimes they may not give you a document. When we think about a scholarship or a fellowship, right, we come back to there's three possible things that we could do to it, right? Number one, we could exclude it. If it was spent on qualified education expenses, right, they were a student for a degree, it was an organization that was approved by the Department of Education to receive student loan funds, all those things, then it can be excluded from their taxes. Nobody has to report it. Nobody gets any income documents. If it is for other expenses, there is a chance if they're from the right country, that will be treaty exempt. So we'll say, hey, you have this income, but you don't have to pay tax on it. Everything else is going to be taxable. You're all going to have to report it. All right. All right. So when we talk about how we report the scholarship, so when it is never provided to the student. So if somebody gets a scholarship, but it just goes straight to their student account and it gets applied against their tuition, we don't have to worry about reporting it on a return, right? The most common example of this is like a tuition waiver. Sometimes they waive student account fees, things like that. The student never actually got that money, right? It's all pretend money. It was just on the account, then it was taken away. If it's treaty exempt, we're always going to report it on Schedule OI, right? That table L, that's where treaty exempt income lives. If it's taxable, we're going to report it on Schedule 1, line item 8R. And then if there are some additional qualified expenses, we'll subtract them on Schedule 1, line item 8Z. So taxable goes on to Schedule 1, treaty exempt goes on to Schedule OI, qualified never shows up anywhere. All right, so that's kind of one scenario that we'll see quite a bit. When we think about, let me come back to this. Where do we find the information about how much they received, right? Usually in that kind of a situation, they're going to have either a letter from whatever company or organization or group gave them that scholarship, right? It'll say, congratulations, Mary, we love you. Come please study accounting with us. Here's $10,000 just to like make it even better for you because you're that awesome. It can also show up on a student account. They got some, fellowship or award, they got some grant, it'll show up there on their student account. So those are the two places that we're going to look. The students should generally know what it is, or they can find their documentation for it. All right, let's talk about the next one, which is treaty benefits do not match. All right, so there's three kind of common situations, well, two common ones and one not so common one. So in the first situation, you got a W-2 for some wages and then a 1042-S for some wages. And your total of your 1042 and your W-2 is less than your treaty benefit. This is very common for researchers, professors, people that have that unlimited treaty benefit for wages. They come to the school, they start working, they don't get into payroll right away to sign their treaty documents. And so that first paycheck they get is reported as taxable income on a W-2. Then everything else shows up as a non-taxable treaty exempt wage on a 1042-S. It can also happen if somebody just works for a tiny little bit and they don't ever fill up that bucket of their treaty exempt income, but usually it's going to be those teachers and researchers there. You can also have a situation where you only received a W-2 for wages, right? You're eligible for a treaty, but you only got that W-2 or you didn't get a 1042-S, right? So this is for people that either work at a college or a school that doesn't do this kind of treaty paperwork, somebody that only works for another company, like a for-profit company. In this case, essentially, right, their 1042-S is zero. So everybody's done. Hopefully everybody's done one of those scenarios, right? This was Sergio's scenario. He worked, he only had a W-2, he didn't have a 1042S. He had $8,000 of income, but he had $5,000 of treaty exemption. So we have to fix it so that he can still claim his treaty exemption. The final one is much less common. It is if you receive two 1042S forms and together they total more than your treaty benefit. I have only seen this happen when we have a transfer student. So imagine you have a treaty benefit for $9,000. You work at your first school, you get a treaty, you earn wages of $6,000. They're all reported on a 1042S. You go to your new school, you start there, you say, oh yes, I'm from wherever, I have a treaty benefit. They say, okay, you earn $8,000 on a 1042S, but your treaty benefit's only $9,000, but you just claimed or thought you got $14,000 where you didn't have to pay any taxes. So, and the treaty benefit is per year, per person. It is not per job. So we have to make the adjustment to now take some of this money that was all reported as treaty exempt and make it be taxable on the tax return. All right. So when we did our adjustment for Sergio, we just did it by hand, right? When you're in the tax layer document, basically in the Schedule OI general information on that first page, there's a box. And if you look at the guide, normally it has this big red X that says, don't enter anything here. This is why, because you only want to do this when you're messing around with income reported on a W-2 or a 1042S. You would scroll down and you would put the amount of his taxable wages that we want to report as treaty exempt in that box. Or if we need to do it the other way, we need to take something that was reported as treaty exempt and make it taxable, you can enter a negative number in there, and that will increase your wages. The guides will show you how to do this if you enter your income documents properly. So, and speaking of guides, so the guides are updated now for 2024. So the new real version is out there. Occasionally, there are a few pieces that we don't update every year. Usually that's just because when we take our run through it, it looks like the old version from last year and this version, or even the version from 2 years ago, is basically not changed. So we're not going to necessarily update it just to update one little tiny 2022 or 2023. If you see anything that you think looks really different that is not updated, please let me know. But in general, it's all updated and done and should be good to go. All right, let's talk about working in multiple states. So here at the U of M, we see this quite a lot. It'll be interesting to see what we find in some of the other schools. So particularly out like in Washington State, UMBC has it quite a bit, Lehigh has it quite a bit as well. So we definitely see quite a few folks that get around, right? They go do some fabulous internships across the US. All right. Generally, the state tax residency, remember, we're going to have to make sure we get our residency correct. So for Pennsylvania and California, right, everybody's going to generally be a non-resident, but everywhere else it's going to depend on how long they were physically present in that state, right? If it's like Minnesota, were they renting an apartment? How long did they rent their apartment? When we look at that, if somebody is treated as a resident, generally for that state, so this is just state residency, not federal residency. A resident for a state, generally everything is going to be taxable. So all of that federal income, whatever it is, it's all going to be taxable in that state. And that is consistent with all of the state tax rules, right? If you're a resident of that state, they want the money. They say you're a resident, they say you should pay tax there. If you are a non-resident or a part-year resident, generally only income that is either earned from working in that state or from a state source is going to be taxable in that state. So for example, if you were a part-year Minnesota resident, if you worked here in Minnesota, you would owe taxes in Minnesota on those wages. If you received a taxable scholarship from Minnesota State Mankato because you were playing hockey for them, that would also be taxable in Minnesota because that is from a Minnesota source, right? Minnesota State Mankato is most definitely here in Minnesota. Scholarships and fellowships in particular, will not transfer automatically, like properly, if you're a part-year resident or a non-year resident. You have to do a little bit of fixing to make an adjusting entry so that those will work. All right. So if you need to do that, so in our personalized guide, we enter our income documents. We say, like, where did you earn this money? I'm going to do the example here, Minnesota and California. We were in both places. That's great. Okay, now we need to know where you were physically present, right? California, we don't care. You're a non-resident. Minnesota, we care. Like, were you here? How many days were you here? So you enter your dates. I was here these days, right? Obviously, I made up easy dates. The system will also pull the information from the F1 visa, like, am I a non-resident alien calculations? So it'll automatically say, oh, you were outside the United States. You can't physically be present in Minnesota or California during that time period because you said you were outside of the United States. Minnesota has the fun question, right? Was where you lived and abode. Did you rent, own, occupy, maintain an abode? So for each of those time periods, you would need to give an answer to that, and it will do the work to tell you, congratulations, you are a Minnesota part-year resident for the year. All right. So this is one of the ways that our personalized guide helps the people where they have a more complicated state tax residency, because then, you know, they don't have to necessarily know all of those rules. They just have to know where were they paying rent or not. All right. All right. So, and if they are in that situation, then they're going to get a guide like this. This is just the front screen, but it'll basically walk them through all of the adjustment steps. Okay. So I know I'm a little bit of a broken record on harping to go back to that personalized guide, but it really does show the process to try to make these adjustments on the returns. That's why we're not going to cover them live here. All right. Any questions on those before we move on? Yes.
I'm just wondering for the clarification. So if one person, say like work in Pennsylvania, but
Yeah.
the company is actually from Minnesota.
Sure.
So how this, like, is it for like, is that qualified for the Pennsylvania state law or Minnesota state law?
Sure. So the way that they source, or way that they attribute where you earn the money, if you are working as an employee, it is where you physically are present when you do the work. So if you are in Pennsylvania and doing the work there, even if the company is based in Minnesota or New York or, you know, Ireland, it's always going to be Pennsylvania wages that you're going to owe.
Then remote working.
Where they are physically working. It doesn't matter if it's like going into an office to physically work or sitting on your computer at home physically working. Where you are physically present to do the work is where the source of those wages are.
Oh, I see. So for example, in a person, he like they work in Pennsylvania, but he remote working from Minnesota. But there is the Pennsylvania, they have like the local tax and everything.
Mm-hmm.
Like in this scenario, how we like collect that or?
So, I mean, so theoretically, his employer should know where he physically is doing his work. And so, and they would say, all right, you're physically present in Minnesota. We're going to withhold Minnesota taxes on that because those wages are earned while you're in Minnesota. So it's definitely the pandemic and on the rise of a lot more remote work definitely made it much more complicated for employers to keep track of. But that's kind of the way they do it. So yes, and so if you were remote working from Tahiti, for example, right? If you were a non-resident alien, that would all be money that's earned outside the US. You wouldn't have to pay any taxes on it. If you were a US citizen and you were doing something fabulous like that, it would be foreign earned income, right? You would not be in the US, even if your regular office was here. But if you're working overseas, that's where your normal place of work is. That's where your money is. All right. Minnesota property tax refund. All right. For those of us that will deal with Minnesota clients, which is everybody, there is no form or topic that generates as much discussion or work as this one. The vast majority of our clients, well, vast majority of our clients, I would say, do not get this refund. About 25% of them are eligible, and less than 50% of them actually qualify. However, probably 80 to 90% of the people get one of the forms that says, hey, here's how much you paid in rent, here's the property taxes, and they look at that number that's usually like $700 or $900, and they think, ooh, am I going to get all of that money back as a refund? No, probably not. Not if you file it correctly. And I will say that this is one area that the Minnesota Department of Revenue is generally a little bit more, pays a little bit more attention to in terms of whether they audit it or not. And there is definitely a penalty for filing a false return, basically 50% of the money that you got back. So we do want to try to encourage everybody to follow the rules and only claim it if they are eligible. So I said that less than 50% that are eligible actually qualify, but in 2024, Minnesota split the property tax refund. So what used to be one combined property tax refund is now two things. There's a Minnesota renter's credit and the Minnesota homestead credit. And we're going to talk about those. So there are some common requirements for both of these credits. The first one is that you have to be a Minnesota resident for at least some part of the year, right? So either a full year resident or a part year resident. Remember, we're going to use that 183-day rule. So physically present plus you rented an abode. Again, that abode, which contains sleeping, cooking, and bathing facilities and is suitable for year-round use, especially on a day like today. The unit also must have been subject to property taxes. So property tax documents like a rent certificate of rent paid or a property tax statement will not be sent to people that live in a building that does not pay property taxes. So a lot of the school buildings, like the dorms, don't pay those. There's school-owned housing. There can also be nonprofit co-ops that have a property tax exemption on their property, and so they never pay any property taxes. So if you don't pay them in the first place, you can't ever get any money back. The good news is that it's available for all filing status. It doesn't matter if you're single or married. This is a reminder of the rules for part year residents and full year residents. We'll skip that. The final one, and this is the one that really gets most people, is that you cannot be a dependent. And in this, they use the IRS definition of a qualifying child or a qualifying relative, which is from Pub 17 or 4012. In this case, it doesn't matter if you're actually being claimed as a dependent. It's if you meet the criteria for the dependent that you are considered a dependent and you are not eligible for the property tax refund. Generally, when we look at this, the simplest rule, the easiest rule to look at is that if an individual did not provide more than half of their own support, they are considered a dependent or qualifying child or qualifying relative, and they are not eligible for the property tax refund. So this is the one that I said gets most of the folks that want to try to claim this property tax refund, because coming to school here in Minnesota is very expensive. And so it is not common for individuals to have the income to provide for over half of their own support. All right, so let's talk about the renter's credit in particular. All right, so the eligibility doesn't change. Those same three things that I talked about. The process for claiming it has changed. So before, this property tax refund was a separate tax return form that had to be sent in a different filing, had a different return due date. Now it is all part of the standard Minnesota return. So it's going to get filed at the same time as the return. It's going to combine with any other credits or amounts that you owe to kind of get a net refund or a net amount of tax owed. The calculation on this has also changed. So those that were eligible didn't change, but the calculation for how much they get if they are eligible did change. Previously, when we took this credit, we had to add back in non-taxable income. That can be things like treaty exempt income, it's qualified scholarships, all of those things. So generally those could be pretty big numbers. Now the refund is simply using your federal tax adjusted gross income. There's no adding back any numbers. So the people that are eligible are likely to get a much larger refund. So there won't be a lot of happy faces in our clinics, but there will be some people and they will be very happy. And then the final thing, this only affects 2024 returns going forward. It does not like retroactively affect anything for 2023. All right. They also made a change for the landlords. Landlords are now required to file their certificates of rent paid electronically through the Minnesota Department of Revenue. So that is a requirement. They've been talking about it for a couple of years and they instituted it at the beginning of last year. So everybody, when they get their certificate of rent form, they should have an electronic control notice number on the top right corner. Obviously, right, this is that whole matching thing, right? They're going to match those certificates of rent paid with what the landlord says and what the renter is reporting. If you have a certificate of rent paid that does not have one of those ECN numbers, so I got this straight from Minnesota Department of Revenue today. First step, request a corrected certificate of rent paid from your landlord. Call the Minnesota Department of Revenue to request a rent paid affidavit if they won't give you that corrected form. You can submit it, right? TaxSlayer is not going to stop you from submitting it without the ECN number, but it will delay the processing of your entire tax return and your refund. So we would want to encourage people not to do that. Because they're cracking down on renters and landlords being naughty. This is an old form. Now that the form is online, they don't have like blank forms that I can use to like fake certificates of rent paid. But this is what the form looked like last year. That ECN number is in the upper right-hand corner is where it'll be. All right. Renter situations really quickly. So if more than one adult lives in a unit, that rent is going to be split equally on the forms. It does not matter how much somebody actually paid, right? I could be paying $1,000. You could be paying $500. We're going to both get a CRP that says $750. So you're going to get like the good deal out of it. If you are married to the person that you're living with, but are not filing a joint return with them, you can now add that person's certificate of rent paid and their adjusted gross income to your tax return, just in this rent area. This means that all of our F1s that are here with a spouse on an F2, they're going to get to add that CRP and they're going to have zero AGI. And so it's going to basically make their property tax refund a lot better as well. So it'll be awesome for them. There used to be a requirement if your income was less than the rent paid to say like, how in the world did you pay for all of this? Loans are a really good example of how you can pay for that if you don't have the income. I don't know if they're going to still require that or not. It's a part of the e-filing process of the checks. I can't test that because I can't e-file. So we'll find out when our clients start to talk about it and we will share that with everybody when we know for sure. All right, so let's talk about the process of doing the property tax refund, right? So we need to make sure that the clients provided more than half of their own support. We need to try to encourage our clients to do that work themselves. The easiest way that we found to do that is to give them this little worksheet. It's very simple, like a quarter of a page. And we basically say, all right, what were your expenses for the year, right? Tuition, you can get it from your student account statement, right? But here at the U of M, it's something like $39,000 a year, right? It's expensive. Rent is going to come from your CRP, right? Food, clothing, fun, got to be something, right? $5,000, $10,000. A full meal plan is $3,000 a semester. So, right, it's easy to hit $9,000 there if you were here all year. If you look at it from the other side, you say, okay, that was how much money that I spent. Let's talk about the money that I had coming in to pay for all of that, right? What earnings did I have? Treaty exempt and taxable earnings. What scholarships did I receive? Did I take out any loans? And then whatever's left, right? That's generally where your family comes in to pay that extra money. And it's right, it's totally okay that their family does it, right? That's great for them that they have family that can support them. But it means that if their family is providing over half, they're just not eligible for the property tax, renter's credit. All right, so we include all that information in there, do that. Again, this is where we knock out like 75% of people. If you are helping somebody in a clinic and they say, oh, I need to help with my renter's credit, make sure you ask them, how did you determine that you are not a dependent, right? Because they need to go through this exercise. I would encourage them. We have paper copies in the in-person clinics. Fill it out, write it out, and then they can keep that with their records if there's ever any question that they're eligible or not. All right, so let's talk about a couple of examples. We're gonna do this and we're gonna do this. All right, let's talk about, get this way, there we go. Let's pretend that Nick Lee, our student from North Carolina, that he actually had moved to Minnesota. Remember, if you do, he was an F1 student from South Korea. He came here in 2022. He went home over the summer. He lived on campus, off campus for the fall of 2024. Let's say that he was in the dorms for the spring of 2024. His campus apartment qualified as a boat. He paid $3,000 in rent. He worked on campus. That was the money that he earned. What do we think his Minnesota residency is going to be? All right. Let's say that he had moved here to Minnesota at the start of the year, 2024. Is he going to be a full year resident, part year resident, non-resident? Do the high, more residency is a higher hand. Really high, full year. Give me a clap, middle, part year, down is a non-resident. So he came to Minnesota on January 1st, 2024, was here in the dorms, went home over the summer to South Korea, and came back 8/13, rented an apartment. So I'm going to say, yep, mid. He's a part year resident, right? He definitely meets that 183 days, but he only rented for the fall semester. That's okay, but he rented an abode. So it's part of the year that he was renting. So he's going to be a part year resident. All right. Who thinks he's going to be eligible for the property tax refund? Raise your hand. You think he will be? All right. I'm going to say no, and I see a lot of non-hands raised too, which is great. So he spent something like 50 grand to go to school here for a year, and he earned less than $9,000. He earned $8,000, right? Or $10,000. He did not earn more than half of the money that it took for him to go to school, more than half of his own support. So he is not going to be eligible for the property tax refund. All right. Let's talk about our friend Lisa. All right. Again, right, we've talked about her so many times. She's an F1 student. She came here in August of 2022. She lived off campus for all of 2024, qualifies as an abode. She worked on campus as well. What do we think about her Minnesota residency? Is she going to be a full year, up high, part year, down low, or non-residents? You want to clap if you think it's up high. Give me like applause, like a fireworks if it's down low online. Yeah. So that's right. She's going to be a full year Minnesota resident, right? She meets the 183 days, and she rented an apartment for the entire year as well. Do we think that she's going to be eligible for the property tax refund? Yeah. She's not as well, right? She earned a little more, right? She earned $13,400. That was great, Lisa, but that's not anywhere near the, 25,000 that she would have to be earning to pay for half of her own support. All right, now our friend Sunil. You guys, most of you have hopefully done Sunil again, right? So he came here, he's been here for a long time. That made the dates easy for us. So he worked at the University of Minnesota. He earned 16,000. Then he also worked out in at Cray. Let's say he worked out in California. So he left for the summer. He was gone. His apartment lease ended, came back, started a new apartment lease. What is his residency going to be? A full year, think, part year, or non-resident? Yep. It's going to be in the middle. He's a part-year resident, right? Because he was here at the beginning and he rented, which was good. Then he was gone and he didn't rent an apartment. So that's the magic there, is that he wasn't renting his apartment anymore. And then when he came back, he rented again. So that period where he didn't rent is going to make him a part-year resident. What do we think about his chances for the property tax refund? Does anybody think he's eligible? Raise your hand. Give me a thumbs up. That's right. Yeah. He's going to totally get it, right? Because if we look at it, he's earning the big money, right? He earned $44,000, something like that. You know, he paid for almost all of his school right there. So obviously he's chosen a very lucrative major to focus on. So he would definitely be eligible for it. What we will commonly see is that a lot of our PhD students will be eligible for the property tax refund, right? Because they get scholarships that pay for all of their tuition, they get a stipend, so that covers more than half of their own support. They're going to be in good shape, whereas many of our undergraduate students are not going to be eligible because they don't have jobs that earn anything like this kind of money, and so their families are supporting them. All right. Any questions about that before we move on? All right. Yep. All right. What happens if they are eligible and they don't receive a letter, like the certificate of rent paid? So if they don't receive a certificate of rent paid, that is totally fine. That just means that they were probably living in a place that didn't pay property taxes. Landlords are supposed to provide that certificate of rent paid if they pay property taxes on their unit. It doesn't matter if the person is eligible or not, right? The landlord doesn't know that you're eligible. They don't know any of that personal business. So the landlords are still supposed to always provide that certificate of rent paid if the unit that they're living in paid property taxes. So I'm not sure what other letter there will be. So Amanda, if you want to clarify that, you can. Okay, so this is what the form looks like. Basically, it starts with federal AGI. We don't have to do any adjustments. It just kind of flows through. It's super fabulous, nice and easy. All right. And then filed with the Minnesota tax return, so it's the same thing. The other really cool part about this, right, is that now you have 3 years after the original filing due date to claim this refund if you didn't do it. In the previous homestead credit, you only had a year, an extra year to file and claim that credit. So now, because it's a part of your regular return, you've got extra time to file it. So that's super good. All right, we're going to go through the Minnesota homestead credit relatively quickly. Basically, when they split things up, they put the rent on this new credit. The existing one, the homestead credit, they made some very small changes, but it really is not changed. They changed the name. The eligibility did not really change. The process for claiming it did not change. It's still going to be this separate tax return form. And the calculation also did not change. All of these people still need to include their non-taxable income, such as scholarships and treaty exempt income. So it is still the pain that's around those there, right? So before we ever get into it, right, they should always determine if they're eligible. They need to determine their household income, what that total non-taxable income is. And that renter's credit worksheet is the tool that we give them to enable them to do that accurately and well. In this case, it's a 3-piece thing, right? They do their expenses, they do their income, just like we did before. We add all of that information in there. As long as the funding goes through a renter. All right, Ben, we'll talk about that later, okay? All right. And then number 3 is the property tax refund. So it was the additional non-taxable income, right? So here are kind of the main categories of what we see. We'll see a lot of treaty exempt income. We'll see scholarships. We also see tuition waivers. So anytime that they take off money on their student account, that all qualifies. Same thing for fee waivers, right? You don't have to pay the technology fee. You don't have to pay the International Student Services fee or the stadium fee. any of those sorts of things, those count as well. Interest also would need to be added back in because that's non-taxable income for non-resident aliens, as well as any dividends or capital gains that were reported on the the Schedule NEC on the 1040 NR. Add that all up to get a year amount, and that goes in there. The one thing I will say is that when we talk about getting a one-stop account or a student account statement to look at the amount for tuition charged, remember that our teachers and researchers aren't going to have that because they are here as employees. They are not here as students. So they're not going to have a one-stop student account because they're not students. All right. So I mentioned that we're going to take a look at a couple of this one here. So this is an old one. It's a real one, but it's old, of what a 2019 one-stop student account looked like, right? And so that first column, that charge, right? Those are all of the things that they were charged when they came to school here. They also had some weird shenanigans going on in January, right? Where they switched them from resident to non-resident tuition. They basically charged them tuition, they charged them student services fees, all that kind of good stuff there. If we look at these two statements here, this electronic payment thank you, right? That is when the client actually paid them money, paid the university money. So that was their out-of-pocket cost. And then everything else on that column, in the payment column, right? Those things were all paid for by the University of Minnesota, right? There was a tuition adjustment, a general waiver. There was tuition waivers, there were fee waivers, right? They did all of those adjustments for them. So those were all things that that student didn't have to pay for. And those are all things that would be non-taxable income for their property tax refund. All right. So this is what we would do. We would add those numbers up. We would look at their return. This is what the form looks like. Basically, your name, your address, start with your AGI. And then the big one, you start adding in those different items. Scholarship, treaty exempt, so on and so forth. There's math, but the software will do that for us. Really, the big thing is those adjustments. This is the very, 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 very long list of all of the things that theoretically could be added back in. But the reality for our students is really that income exempted by treaty and scholarships are the main ones that we're going to see. All right, there's the last of the page. That's going to go off. This still has the original dates as well. So it's due on August 15th. You can file it with your regular Minnesota and federal returns, but it's not officially due until August 15th. And then you have a year after that August 15th date to file. If you don't file within 1 year, then you no longer can claim that refund. If you make a mistake, you can fix it for 3.5 years, basically, but you have to have filed in the first place to fix it. All right. And with that, let's take a break. So, because that was lots. All right. So it is 6:23. So let's restart at 6:28. I'm going to check the chat. Yes. All right. And I'm going to pause here and then I'll read all of Ben's notes. All right. Let's do it again. We're going to do a demo. We're going to show you guys what it looks like here. I have it bookmarked. I'm going to not even do that. Let's go here. So North website, you sign in. You do not need all of the memberships, but we're going to do, go there. All right, go to do your taxes. Click here to access the software. This lovely screen is your welcome. All right, they have changed the system this year. And now it requires that you have a phone number that can receive text messages. In the past, it used to be that you could kind of get around that, but now every single time you log in, it is required. I have some ideas of some workarounds that would be free. They're not like pretty, and I don't know if they would work, but I know that we're going to have some clients that do not have a phone to receive text messages. And so if we do have anybody that is in that situation, please tell them to email us for the tax help email, and we will talk them through hopefully some options that will be free and good. All right. I'm going to clear the history and restart everything because I want to start at the very beginning. And you don't need to see all of the messing around that I do. All right, let's try it again. And then when you log out, the link is not the same. So it'll make you do it again. Do that, do the code again. Go. There we go. Okay. All right, here we go. Welcome. Let's get started. So you can see right away that looks a little bit different than the version in the tax layer practice lab. So it is definitely intended to be a little bit more user friendly. Congratulations, your account has been created. We're going to skip this. We don't want to upload any copies. We're going to enter the name. Which is very clever. I'm going to do zeros so that I can't accidentally file. This is the live system. You would, if you put a number in here, you would file for somebody. So it is real. Let's say date of birth of 2000 and student as the occupation.
Maria, this is Kathy.
Kathy.
Is it advisable if they're returning to tax layer user to use their account, their account from the previous year?
Yes, absolutely. So TaxSlayer will save their information from last year, and it is supposed to copy at least some of it over. So it'll definitely copy like refund amounts and all of that over. It'll copy your AGI. So when you get ready to file, you don't have to enter that, look it up. It'll just have that in the system. So yes, if they can use the same account, that would be the best. They just need to make sure that they go to the link on our website to first create their account or first sign in for this year. Otherwise, they'll have signed in on another account on the paid version, and there's no way to like convert that over, I don't think. So
Thank you.
you bet. All right. Obviously, it saved my address information. So one thing we're doing differently this year, we're going to say I'm a part-year resident of the state. That is not true. That doesn't matter. We're always going to just say I'm a part-year resident of wherever we are. This is all of those same personal questions. All right. Support was affected by the natural disaster. Whatever it is. 3917 and see, that's not the right number, but that's okay. They were a student. Off we go. Still the same non-resident, same single. No dependents. No PIN. Confirm. That's all good. Say no here, unless you want to get lots of reminders about all of their fabulous services. You don't have to say no. So we just say, just skip this here. If you say yes there, you will get lots of warning messages. You said you wanted to enter a W-2. Did you enter your W-2s? Are you sure you've entered all of your information? And the clients get very worried. Why am I getting this warning about this? Well, it's because you said that at the very beginning, and now it's wanting to try to double check and make sure it's all right. So after that, everything looks very similar. Obviously, I'm going to just do a little bit of a shortcut here, right? General information, schedule OI. You know, it's all the same thing. I don't know why they let you choose United States there. That is terrible, but that's okay. Right? We do all of the same information here. Remember, this one is at the bottom. Don't put a number here unless you're fixing things. The dates are entered now. You don't have to put a exit date anymore, which is fantastic. That's all good. We would go to federal. Miscellaneous forms would be right here. So here it does say aliens exempt for medical conditions and other reasons. So it's all of our same standard 8843 information. Income is all the same as well, right? Just a standard W-2. Got all of the information that you would enter, wages, so on and so forth. Make sure you delete the Social Security and Medicare wages. The wrong one. Payments and estimates is where our 1042S lives. Withholding, our foreign person's US income subject to withholding, right? That's where we do this. It also has a code number. Number of boxes that you actually need is very small. You need to enter your code, your wages. And then you can scroll down to code 16 here, which is the person that received it, is an individual. And there you go. That's all you need to enter. All right. I'm going to skip over that. We're going to go to the state really quick just to show you what it looks like. So because we did that part year resident, now it lets me select the state. I can select wherever I want to go. Select your residency. Again, right, these definitions are not necessarily the right ones, but that is what it is. All right. We need to enter anything here we can. Disaster relief. Go for Hurricane Helene. There we go. All right. There we go. So that's kind of what it looks like. So you can see, I'm not going to like do a whole return because you guys have done a bunch of them. It's really just to show you that it's very, very similar, but it is not identical to the software that you guys are using to practice, right? However, the personalized guide, right, those are screenshots of the actual screens. So when our clients are seeing it, it is going to match, like what's on that PDF is going to match exactly with what they see, or should be close enough. All right. Any questions or comments about that before we move on? Okay. All right. Let's log out, say goodbye, come back here. Okay. Gonna do that. Okay, so we're gonna make some progress on states a little bit, and then we're gonna stop. We're gonna get through Kansas, and then we're gonna call it for today. And we'll turn you guys over, turn in. Okay. So, this has been one heck of a week with all of the excitement coming out of Washington. So today I have prioritized having some basic tax training over building all of the Moodle assignments. So if you look at that, you will see that there are not a bunch of things that went live today at 5:30 like I usually try to do. That's just the way, unfortunately, it's been this week. So these will come as the week progresses. My goal is to have you guys through all of the practices on the different states, plus the special circumstances. So the last examples that you're going to do on states, particularly some of the multi-states, you're going to get to do some of those special circumstances, right? When your income documents don't match, when you have to allocate income, when you have to put extra income back into the state because it doesn't transfer, all that kind of good stuff. So you're going to get those here over the next week. And then on Tuesday of next week, we're going to do a little bit more training, mostly focused on like the reality of what is it like to do the tax clinics. And we're going to talk about the volunteer readiness check, and we're going to turn you loose on that, right? And that is the last thing that you guys need to get through to be ready to volunteer. So you've made it an amazing far in this process. It's really good. One other comment on the states from the fabulous IRS Lincoln Learn training. They had this lovely list that I thought I would share with you of all of the states that supposedly don't allow treaty benefits. I haven't verified every one of them individually, but certainly Alabama, California, Montana, Maryland, and Pennsylvania, they all don't do that or don't allow treaty benefits. So that the list is legit as far as I'm concerned. So this was our original list. Kansas and New York kind of fall in between the North Carolina and Pennsylvania, I would say. Maryland is not quite at the Minnesota level, but it's a little bit more complicated. And Ohio is down there as far as what I can tell. And Alabama is still a question mark for me. So let's talk about Maryland really quickly, right? This is another one of our big schools, University of Maryland, Baltimore County, right? So we start with any state, we start with residence, right? So you are a full year resident of Maryland if you have a permanent home that is or was in Maryland. And in this case, the law is referring to your domicile. You can also be a full year resident if your permanent home is outside of Maryland, but you maintained a place of abode or a place to live for more than 6 months of the tax year. If this applies to you and you are physically present in the state for at least 183 days, you must file as a full year resident. And I love when they write their laws like this because it's so very vague, right? More than 6 months. What does that mean? Like any part of more than 6 calendar months? So if I was like here one day of every 6 months, would that be more than 6 months? If it was 7, does it matter the number of duration days that I was here? What does it matter if it's more than like 6 duration months? Does it need to be like that? In which case, like which ones do you choose? Do you choose all the shortest months or the longest months? An abode is not really defined, right? They don't define it here, at least. Could be a place to live. That could be a lot of places, right? It could be a hotel room. It could be a house. It could be an apartment. It could be a car. It could be a tent. It could be anything. And then part year residency there, whatever. So what are we going to do? A place to live, anything counts, right? Doesn't matter if it's a hotel, apartment, et cetera, et cetera. If you counted up all of the shortest possible months, to get 6 months, you'd have 183 days. Count up all of the longest possible months, it would take 186 days. So if you're less than 182, less than or equal, you have to be a non-resident. That's very easy. If you're more than 187, we know that you must be a resident. That's also very easy. If you're in the middle, we're going to count how many calendar months you were present. Was it 6 of them or was it 7 of them? If it's less than or equal to 6, then you're a non-resident. If it's more, then you're a resident. That's how we're going to do it. Unfortunately, you guys don't have to do any of that math. That's what the personalized guide is for. We're going to let them put their days in, and then they will run the calculation and do it that way. From a practical perspective, generally, students, if they are here for the full calendar year, spring semester, fall semester, they're going to be residents. That very first fall that they arrive, they're going to be non-residents. Likewise, that last semester before they graduate, that would also not be 183 days. They're going to be non-residents as well. All right. General tax rules. So for Maryland, you're going to use the same filing status as on your federal return, which is either single or married filing separately. Everybody can claim the standard deduction or itemized. It doesn't matter what you did on your federal return. They do not honor tax treaties. However, if you are married and from Canada, Mexico, India, or South Korea, you may be able to claim your exemption for your spouse on your Maryland return. There's some requirements about them living with you, but other than that, it's okay. They do have a local tax, but it's collected as a part of the state tax return. It's not a separate form, so that's really easy. You just have to enter the county that they lived in when you're filing that return. You have to file a Maryland return if you filed a federal return and you were a Maryland resident, or if you were a non-resident and had Maryland tax withheld or Maryland source income. Maryland also has reciprocity with these other states. So it is theoretically possible that we could have somebody that is a Maryland resident and a Pennsylvania non-resident. All right, there is a Maryland earned income tax credit, but non-resident aliens are not eligible, just like they are not eligible for the federal return of or federal credit there. They also have an online direct e-file system called iFile. So for the people that can't e-file their state through TaxSlayer, we will send them to that so that they can file their return electronically there. And that will be perfectly good and perfectly fine. All right. In addition to the other fund, the University of Maryland, Baltimore County has a unique way of reporting their income. So let's imagine a student from China. They have $5,000 of wages on a 1042S code 20. They have a $7,000 scholarship on a 1042S code 16. And then they had $9,000 of taxable wages. All right. So they have theoretically a total income of $21,000. But of that, did I do that math right? Yes, I did. Of that, 12,000 of it is treaty exempt. That lucky individual would receive a W-2 that looks like this, where they have $9,000 reported as taxable wages for federal and $21,000 reported as taxable wages on their state. So the good news is that it gets it into the software, it gets it into the system to report it all. The bad news, right, is that that's not really wages, all of that. There can also be some challenges when like the amount of state tax withheld is more than the wages received. So there can be some fun stuff that comes from a Maryland return. All right, let's talk about New York for a little bit. Is Linda on the line? If you are, Linda, please keep me honest if I've gotten anything wrong from our discussions.
Okay.
Thank you, ma'am. All right, so residents for New York, right? We always start here. So residents are either going to be domiciled in New York or maintain a permanent place of abode in New York State for substantially all of the tax year and spend 184 days or more in New York State during the tax year. In this case, they do somewhat define an abode as a residence, building structure where a person can live that you permanently maintain and that is suitable for year-round use. There is an exception though for New York, which is that undergraduate students are automatically non-residents of New York. So it's not going to be all students, but any undergraduate students that we have are going to be non-residents. So undergrads get to use the exception, they're a non-resident. The other people would do the same counting of the days. Do you have an abode in New York for those days? Most likely, well, who knows, right? They may rent an apartment all year. And so they would have that permanent place of abode for substantially all of the year. It's hard to say. New York does honor tax treaties. If you are a resident of New York, you need to file a New York return if you have to file a federal return. If you are a non-resident, you only have to file if you have New York incomes that's greater than the standard deduction, which looks like it's about $8,000. We're always going to just recommend that they file their state tax return anyway, just to make sure that it's filed in case they have to. There is also a city tax for residents of New York City and Yonkers. Hopefully we will not see a lot of those. Otherwise, there's not going to be a city or local tax. And then on the filing status, it's basically going to be the same as on the federal return. All right. Linda, anything to add? I think that was the last one. Oops, scholarship adjustment. Yeah, so basically there's two things. Again, like if there's a part-year resident, we may have to adjust to make it show up on the New York return. And then New York also has a really fun wrinkle in that they don't consider books and equipment as a qualified education expense. So if somebody had a qualified education or had a tuition or a taxable scholarship, and they subtracted qualified education expenses from that, if any of those were books or equipment, we would have to add those back in on their New York return. So a little bit of a pain. All right, now Linda, any other comments to add?
No, only that I am combing through all the various credits that New York offers to make sure that whether there are some that apply to non-residents. It doesn't look like it yet, but I still have a few more to comb through.
Sure. Yeah, I looked at a few of them and the obvious ones were not, they were not going to be eligible.
Exactly.
I did not get through all of them. So
Yeah.
Thank you. Fabulous. All right. All right. Let's talk about Kansas. All right. Resident individual, residency for candidates means a natural person who is domiciled in this state. Love how everybody has a different definition. So, and then a natural person who spends in aggregate more than 6 months of the taxable year within the state shall be presumed to be a resident for the purposes of this act in the absence of proof to the contrary. And a non-resident means an individual other than a resident individual. So I'm not gonna fight about it, right? But I think I would question, right? Would proof to the contrary be a visa that requires your departure and proves that you cannot establish domicile? It seems like maybe that should be the case. But this is also very similar to our North Carolina residency, right? They have the added thing to say in the absence of convincing proof to the contrary, not just any proof. So for now, we're going to use the same rules that we're using for North Carolina, which is basically we're going to use 6 duration months, more than 183 days. You're going to be a resident, less than or equal to 183 days, or a non-resident. So it's a relatively straightforward residency determination there. The fun for Kansas. The first time you ever file a return in Kansas, you must file on paper. Evidently, there were people that were being naughty and they instituted this to try to prevent that. Yes. So Kansas does not honor tax treaties. You're going to use the same filing status as on your federal return. They have an exemption amount that's about $9,000 plus an amount for any dependents that you can claim on your federal tax return. And there's also a standard deduction amount as well. So I think theoretically there might be a decent number of folks that wouldn't have to file a Kansas return. They would only have to file to claim a refund. We're going to still encourage them to file just to get that out of the way, even if it is paper that first time. That was the first time that I've ran into that particular unique wrinkle. But that's okay. It is what it is. All right. Alabama is not done. Ohio is not done. So we're going to move on. Any questions on those other states? All right. So part of the reason why we're doing some of those other states, so you heard me talking with Linda. Linda's one of our partners out at Bard College in New York State, right? So as we work to support schools across the United States, we get connections with them, we talk to them and we say, hey, let's recruit some volunteers at your school. Let's have some tax clinics at your school. Let's learn how to do taxes for your students as well as all of our students. So that is why we're adding in some what seem like very random states. It's because we get random connections and so we grow from there. Yeah, any other questions on states? Okay. Any questions from the peanut gallery online on states? All right. So I'm going to remind you that, we're not expecting that everybody's going to be an expert in all of these states, right? But all of this stuff is what we're going to be building in. So like New York and Kansas aren't built in yet, but all of these things we build into the personalized guide so that the students will get those same instructions so that they know what they need to do to determine their residency, if there's anything they need to enter or any questions that they have to answer, and then how to prepare the forms correctly for that, right? And so we're going to provide you with the shortcuts like what we have here so that you can help them through that process and ask the right questions to say, hey, what kind of a student are you if you're in New York, right? Are you undergrad or graduate? Well, then like that makes life so much easier than all of this counting stuff. Okay. So for the rest of tonight, we're going to stick around here for a while longer. The goal is to catch up on your assignments. I was grading earlier. I will grade here when we're done. And I will get all of the other scenarios up for everybody. But we want to get through all of our special circumstances scenarios, all of our state scenarios so that everybody's caught up by Tuesday. So again, we want to be caught up by Tuesday. Because it's our last training session. So we're going to talk about NRV TAP leadership team opportunities for 24-25. We're going to talk about the clinic process review, like what to expect at the clinics, both for the in-person ones and the remote ones. We're going to talk about that final readiness check, review all of our goals, what needs to be done, timing of getting that done, right? You have to get that done before you can volunteer. If you have signed up for one of the first events, like there's a Friday, February 21st office hours session, remote session, and there's people that have signed up to volunteer. So you need to get on your stuff so that you can get everything done in time. We're also going to celebrate the end of, ooh, it's not Raising Cane's. I think it's going to be Chipotle again, right? Sorry, it's wrong. It's last year's. Assuming that they arrive, we're going to be doing t-shirt handouts here at the University of Minnesota. The volunteers at the other locations, their t-shirts will be on the way once they arrive. You can do your own return if you want, but it's going to be much more of a work on things night to try to get you guys through that volunteer readiness check. All right, and with that, we're going to wrap it up and say thank you. We'll see you next week, and we'll see you in Moodle. I'm going to stop sharing.
Thank you.
Thank you. Stop recording.